Welcome back, everyone. Disney has just announced that they have topped 100 million paid subscribers on Disney Plus in only 16 months after the service was first launched. And by 2024, we are now projecting to have 260 million users on the service. And the company also shared some great news that they have plans to reopen Disneyland within late April. And CNBC analyst Jim Cramer gave his opinion on Disney going forward and the potential reopening of the theme parks very soon. And let's hear what he has to say.
I mean, when you get these theme parks open, they did restructure this company during this period. I think the profitability of Disney is going to be remarkable. Happy birthday, belated birthday to Bob Iger yesterday. And I think that what you're going to see is a Disney that's going to make so much more money per person that you're going to be staggered at what this company is going to be able to do. They have taken advantage of a very difficult time for them and really reinvented the company. Carl, I think it's going to be remarkable.
And I absolutely agree with Cramer. What Disney has been able to do during one of the toughest times in the company's history is absolutely amazing. And going forward, with the massive growth potential of their direct-to-consumer streaming, plus the potential reopening of their theme parks all across the world, I think Disney can still grow much larger than where they are today. The company currently trades for $194 and is up 64% over the trailing 12 months with a market cap of $344 billion. And right now, many investors believe that Disney has run up too hard and too fast, and that their current market cap of $345 billion is already fully priced in to all the potential positivity of an economic reopening happening over the next 12 to 24 months. But let's take a look at what Jim Cramer has to say about the current size of Disney and the potential for them to climb to new highs.
It's all about direct to consumer. It's all about the focus of the company. Although when theme parks reopen and people actually start going to movie theaters again, that won't be a bad thing for Disney.
It's going to be huge.
Now at a $345 billion market value, is the reopening already taken account of in that stock price?
Well, not if you have a Roaring '20s view that it's going to be years worth bookings. See, I think it's not a quarter. I think it's, people are going to be booking for 2023. I think that's what's going to happen.
So hopefully Cramer's right, and over the next few years, Disney gets a massive inflow of bookings, and these theme parks can start bringing in some profits that they lost throughout 2020. So overall, Disney is definitely a very interesting company right now. We had to discuss them today because of the major milestone of crossing 100 million paid subscribers in only 16 months. And right now the company believes they can reach over 250 million throughout the next few years. And during the pandemic, Disney restructured their business to prioritize the direct-to-consumer content space, and they announced plans for 100 film and television projects over the next few years, and 80% of those are planning to go directly to Disney Plus. And that includes around a dozen Marvel series and more than 10 Star Wars shows. I love that the company is going to focus on that content creation, and I believe they have one of the strongest competitive advantages in the entire sector because they already own some of those well-known characters and intellectual property within the entire entertainment space, and the company has been creating this media over the past few decades with great success. And right now, when you think of streaming, two main companies come to mind, and that of course is Disney and Netflix. And going forward, a new report with research from Digital TV Research claims that Disney will become the world's largest streaming service by 2026 with 294 million users, and Netflix will be a close second at 286. And they believe these are the only two streaming platforms to cross that 200 million subscriber mark over the next few years. And going forward with Disney, for their subscriber base to continue to grow, they're going to have to focus on the Indian market, which is absolutely massive with over 1 billion people. And the company already has a very nice plan to grow in that market. And they are partnering up with an existing business, which is Hotstar Streamer. And that is the firm's partner in India, which is already well established and actually owns the exclusive streaming rights to the highly popular Indian Premier League cricket competition. And I think Disney executives made the right decision to partner with a well-established company already in the Indian market rather than trying to enter in on their own. I think it's going to save them billions of dollars in mistakes, and that expertise of the culture is going to help the brand grow at a much faster rate than if they were trying to learn it on their own. And going forward, when you're trying to place a value on Disney stock, like we heard Jim Cramer speak about, the future, of course, is the digital and the streaming services, but also the return of the theme parks, which is expected to come back very soon. And if we take a look at that segment of their company, we can see that throughout 2020, the park segment generated $16.5 billion in total revenue. And that was a decrease of $10 billion from 2019. So in one fiscal year, the company's park segment dropped $10 billion in annual revenue. And going forward, we're expecting that rebound to come back slowly over 2021, 2022, and into 2023 and beyond. And I think investors who are staying out of this company right now because they believe the reopening is fully priced in are underestimating what's going to happen once this revenue continues to pick up and can actually surpass the pre-pandemic levels. And now we're going to take a look at Disney's income statement to see how well the company performed throughout the pandemic. So we can see that before 2020, total revenue was on an upward trend each and every year, and at the year end 2019, they generated $69.6 billion of total revenue. Then of course 2020 hit, that went down to around $65 billion, and in the trailing 12 months, the company has generated $60.7 billion of total revenue. So right now, just looking at the numbers, that looks like it was a very tough year, going from around 70 all the way back down to 60.7. But I personally see the opposite. I think that is a very impressive number from a company that was essentially destroyed throughout this pandemic. Their theme parks were shut down, cruise lines were shut down, their retail locations all across the country were forced to shut their doors, and there was very little box office revenue coming in. So the fact that they were able to generate over $60 billion of revenue during the past 12 months, even with all these major setbacks, I think that just shows how resilient of a company Disney really is, and going forward in a strong economic condition that is actually beneficial for their brand, I think total revenue is going to flourish, and over the next few years, I wouldn't be surprised if we see Disney cross that $100 billion revenue mark for the first time in the company's history. And if we take a look at their bottom line or their net income, before the pandemic, this was a highly profitable business, generating tens of billions of dollars of income each and every year. But of course, as of late, that has completely reversed, and over the past 12 months, they have actually posted a net loss of around $5 billion. But like Cramer mentioned right at the start of the video, and I do personally believe as well, that once everything starts to come back, these numbers will flip and Disney will go back to being a very profitable business. And if we take a look at their balance sheet as well, at this current point in time, they have around $34.8 billion of total current assets, which is well above their short-term debt of 26.5. So a nice current ratio, well above 1, and no liquidity issues over the short term, which is a great sign. And I think Disney, in their current financial position, will get them through the next 12 to 24 months with no financial hardship. And now, with the growth of their subscription models, they're going to have that consistent revenue and cash flow coming in each and every month, which will keep the business running. And if we now take a look at some analyst projections for the company's future growth, we can see that Disney is considered a buy right now with 6 strong buys, 16 buys, and 7 holds, and no one is selling out of this company at this current point in time. And over the past 6 quarters, we have 5 positive earnings surprises. The only miss was throughout the height of the pandemic, and every other quarter except that big loss, we can see a massive beat on EPS expectations. And going forward, in 2021, we're only projecting around a 5% growth in annual revenue because we're still within that massive pandemic area. But going forward into 2022, as hopefully the vaccine is fully distributed, we're projecting over 31% growth in Disney's total revenue, and that will climb to a record high of over $85 billion, surpassing the pre-pandemic level. And if we take a look at their earnings over the next 3 years, total net income is forecasted to grow at over 39% per year, and from their current net loss position, we can see that by year end 2022, we are expecting them to be profitable once again and going forward, that's only expected to climb to back over $10 billion and reach record highs by 2025. So I think this company has a ton of future growth up ahead, and although they are on a massive run-up, I can absolutely see Disney being worth over 500, 600 billion over the next few years. And right now, Yahoo Finance has the company rated as a 2, which means it is a buy. With the current share price of $194, it sits slightly below their 12-month expectation of $205 per share. And right now, Disney is at a very interesting point in time. They have seen a massive run-up as of late, and I think during any future dips we see in share price, it may become a very attractive company to add to your portfolio. Over the long term, the company does have plans to reinstate their dividend, and over the next few years, as Disney Plus continues to reach greater scale, they expand into greater markets, and the theme parks come back at greater capacity, I think Disney will be much larger than where they are today, and I have no problem saying that I expect the share price to climb to 250 or 300 over the next few years in the future. So definitely take a look at Disney right now. The massive headline that they've topped 100 million paid subscribers in only 16 months is absolutely incredible, and I think this is definitely a name brand that's going to be around for decades over the long term, and I don't see any other entertainment company in the world surpassing Disney in that market leadership position or taking over what the company has established and done over the past few decades. Their intellectual property is so strong, they're building on the existing storyline of their characters, and over the next 5 to 10 years, I think they're going to produce so much content, it's going to set them apart over the long term. And now we're going to wrap up the video. I appreciate you watching to the end. Please hit that like button and subscribe if you haven't done so already. I am the Gen Z Investor. Every single day we talk about the stock market, discussing any major market news, and of course, different stocks you could buy for your personal portfolios. So please hit the like button, subscribe to the channel for the daily videos, and I will see you in tomorrow's episode.